Hello, bosses. Welcome back to Boss Economic World. I'm your host, the guy who reads the footnotes so you don't have to. Today is December 12, 2025. Mark this date. Why? Because yesterday, the Federal Reserve didn't just cut interest rates. They didn't just tweak the cost of money. No, bosses, yesterday we witnessed the beginning of a polite suit anti-mutiny. We saw the opening shots of a civil war inside the marble halls of the Eccles Building. On the surface? It looks boring. A 25 basis point cut. Yawn. But underneath? It's Game of Thrones, but with economists. We have a lame duck chair, Jerome Powell, trying to land the plane. We have a president, Donald Trump, shouting from the control tower that the plane should be flying faster. We have a successor in waiting, Kevin Hassett, measuring the drapes for the chairman's office. And here is the kicker: we have a silent dissent from the regional Fed banks that tells us the system is cracking. Grab your coffee, or your whiskey, I don't judge. Let's peel back the layers of this onion and see why your portfolio might be crying tomorrow. So, let's look at the headline. Yesterday, the Fed cut the benchmark rate by 25 basis points. We are now sitting in a target range of 3.5% to 3.75%. This is the third straight cut of 2025, on top of the triple play of cuts we got in 2024. Powell steps up to the microphone, looking like a man who has aged 10 years in the last 10 months, and says, "We are well positioned to wait and see." He calls the current rate neutral. Now, for those of you new to the channel, let's explain neutral. In economics, the neutral rate is the Goldilocks zone. It's the rate where the economy isn't overheating and it isn't freezing to death. It's just right. Powell is telling us, mission accomplished. We are at neutral. We can rest now. But here is the truth, bosses, he is lying. Or, at the very least, he is hoping you don't look at the data. Why? Because inflation hasn't gone back to sleep. The latest CPI prints are hovering closer to 3% than 2%. Powell admitted yesterday that the action was taken to allow inflation to resume its downward trend once the effects of tariffs have passed through. Did you catch that? That's the most important sentence of the year. He admitted that the tariffs, the hallmark policy of the Trump administration, are going to punch prices in the face. He explicitly stated the peak price boost from higher import duties will hit in Q1 2026. That's 3 months from now. So, think about the logic here. Inflation is sticky. A massive inflationary shock is coming in January/February. And yet, the Fed is cutting rates? Usually, when inflation is coming, you raise rates. You tighten the belt. Powell is loosening the belt while staring at an all-you-can-eat buffet of price hikes. Why? Because he is trying to stabilize the labor market. Translation: the jobs numbers are getting scary, and he's terrified of a recession hitting right as he packs his bags. Now, let's look at the political theater. You'd think President Trump would be happy with a rate cut, right? Cheap money is the mother's milk of real estate, after all. Wrong. Within hours of the decision, Trump blasted it. He said the move could have been double the size. He wanted 50 basis points. He wants 50 basis points like a kid wants a double scoop of ice cream. And who is whispering in his ear? Kevin Hassett. Remember that name. Kevin Hassett is the director of the National Economic Council, and he is the reported front-runner to replace Powell when his term as chair expires next May. Hassett went on Fox News before the announcement, which is a power move, by the way, and called 25 basis points a small step. He threw Powell under the bus, saying that if Jay had just presented a stronger set of supporting data, he could have convinced the committee to cut deeper. This is psychological warfare. Hassett is essentially saying, the current chair is weak. He can't sell a deal. When I am in charge, we are going to slash rates. But here is the irony, and it's a rich one. Hassett thinks he can walk into the Fed next May and just command lower rates. But the data from yesterday suggests that whoever takes the throne next year is going to be sitting on a bed of nails. This is the part the mainstream news missed. They focused on Powell's speech. We need to focus on the voting mechanics. The Fed isn't a dictatorship, it's a committee. And the committee is revolting. 2 policymakers, the presidents of the Chicago Fed and the Kansas City Fed, voted against the cut. They wanted to hold rates steady. They looked at that sticky 3% inflation and said, "Are you crazy? We can't cut." But the dissent goes deeper. We have the dot plot, that chart where Fed officials anonymously predict where rates will go. 4 officials penciled in no change as the appropriate move. Anna Wong over at Bloomberg Economics calls these silent dissents. These are people who didn't have a vote on the main committee yesterday but are screaming silently that this is a mistake. And here is the smoking gun. It's technical, so stay with me. When the Fed cuts the main policy rate, they also cut the discount rate. Usually, the boards of the 12 regional Federal Reserve banks submit a request to change this rate. It's a rubber stamp. If everyone agrees, all 12 banks ask for the cut. Yesterday, only 4 of the 12 banks asked for the cut. Let that sink in. 4. That means 8 regional Federal Reserve banks, 2/3 of the system, did not formally request the easing that Powell just delivered. We will have to wait for the meeting minutes to be sure, but this looks like a massive vote of no confidence from the regional presidents. Why does this matter? Because if Kevin Hassett thinks he is going to walk in next May and slash rates to zero to please Trump, he is going to face a wall of opposition. The Chicago Fed, the Kansas City Fed, and potentially 6 others are signaling that they are terrified of inflation. They are not on board with the cut rates plus high tariffs experiment. The U.S. central bank is fractured. And a fractured Fed is a volatile Fed. So, if the Fed is split, and inflation is coming, and the president is angry, why did the S&P 500 rally yesterday? Why did the bond market party? Because, bosses, money never sleeps, and it loves liquidity. While everyone was fighting about interest rates, the Fed quietly announced the restart of expansion regarding central bank purchases of Treasury bills. Powell called this a technical move. He said, "Nothing to see here, folks, just plumbing." Bullst. When the central bank buys Treasury bills, they are injecting cash into the system. They are printing money. You can call it balance sheet management, you can call it technical adjustments, you can call it FRED. It doesn't matter. It is liquidity. The market doesn't care about the 25 basis points. That was priced in. The market rallied because the Fed just turned the fire hose of cash back on. Investors are betting that the Fed, scared of the bond market breaking, is going to flood the system with cash to keep yields from spiking. This is why stocks went up. It's the bad news is good news trade all over again. They know the economy is shaky, so they expect the Fed to print. But there is a catch. There is always a catch. We have to talk about the government's credit card. We often think the Fed controls borrowing costs. And they do, at the short end. But the long end, the 10-year yield, the 30-year mortgage rates, that depends on whether investors trust the U.S. government to pay its bills. Right now, the U.S. fiscal situation is, let's be polite, a dumpster fire. There is a fascinating new analysis out from Oxford Economics, shout out to Felipe Camargo there. They crunched the numbers on what actually moves the bond market. They found that the market ignores the monthly budget deficits. Those are just noise. But, and this is huge, projections for the long-run fiscal balance move the needle significantly. Camargo wrote, our statistical tests show that bond yields respond to changes in our long-run primary fiscal balance forecasts up to a year after the change. Here is what that means in plain English. The bond vigilantes are looking at 2026, 2027, and 2028. They see the Trump tax cuts likely being extended. They see tariffs. They see spending not going down. If the market believes the long-term deficit is spiraling, they will demand higher yields on U.S. debt. This creates a death spiral for the Fed. 1. Trump demands lower rates. 2. The Fed cuts rates. 3. But the fiscal deficit scares the bond market. 4. So, long-term rates goes up, not down. 5. Mortgage rates stay high, even if Powell cuts to 0%. This is the nightmare scenario for 2026. The Fed loses control of the long end of the curve. Powell knows this. That's why he's talking about technical adjustments to manipulate the rates down. So, what is the full picture? Let's connect the dots. 1. The economy is fragile, the Fed is cutting because the labor market is shaking, not because they won the inflation war. 2. Inflation is reloading, tariffs in Q1 2026 are going to spike prices. The Fed is cutting right into an inflationary storm. 3. The Fed is at war, the regional banks are revolting against the easing. Powell is a lame duck. Hassett is waiting in the wings with a knife. 4. Liquidity is the drug, the market is rallying on the technical money printing, ignoring the fundamental cracks. What should you do? If you are a borrower, don't expect mortgage rates to plummet just because Powell cut. The fiscal deficit and inflation fears will keep long-term rates sticky. If you are an investor, be careful. The market is partying on liquidity, but the silent dissents tell us that the smartest people in the room are getting nervous. When 8 out of 12 Fed banks hesitate to cut, you should hesitate to go all in on risk. We are entering a period where politics and economics are going to collide. Trump wants growth at any cost. The bond market wants fiscal discipline. The Fed is caught in the middle. My prediction? Volatility. Massive volatility. Powell is trying to exit gracefully. He's like a guy sneaking out of a party right before the cops arrive. He wants to hand the keys to Hassett and say, good luck, pal. It's your mess now. But until then, keep your eyes on the 10-year Treasury yield and the inflation prints in January. That is where the truth lives. That's it for today. Money never sleeps, and neither should your attention span. Like, subscribe, and tell me in the comments, do you trust Powell, or do you think Hassett should take the wheel right now? I'm the boss. See you in the next one.